Welcome to Trader TV. I'm Dan Barnes. Today we're discussing transparency in the fixed income markets. Transparency is fundamental to finding the right price for fixed income products at any one time and ultimately has an impact on end investors. Speaking with me is Jason Waight, Head of Regulatory Affairs at MarketAxess. Jason, welcome to Trader TV.
Hello Dan, thanks very much for having me.
What are the risks created by having too little transparency? What are the risks created by having too much transparency?
These topics are debated a lot, and I don't think there's any easy answer. But if we think about it, too little transparency creates market asymmetry. So somebody has the information, somebody else doesn't, right? So there's always a possibility that some sector of the market may be losing out. And certainly a driver for the consolidated tape is policymakers' fears that the retail investors may particularly be losing out in the absence of a consolidated tape. And they're probably right, because professional investors today probably do have a higher level of information. Too much transparency? Well, the bond markets are still dependent on dealers being prepared to take risk positions. And if that preparedness reduces because they don't feel sufficiently protected by the transparency regime, then we have a liquidity problem. So it's that balance.
Whereabouts would you say there are weaknesses in bond market transparency at the moment?
I think the biggest weakness is how poorly it's generally understood. There's a lot more transparency available in the market than most people realise. So, for example, MarketAxess' predictive pricing tools generating around 30 million levels per day globally on what the next traded price is likely to be in around 25,000 bonds. So there's a lot of pricing information out there. I think possibly the biggest issue is, do investors and dealers know where to access it from and whether that's really available to the retail investor market, which I think is probably the primary driver for a number of the policy initiatives you're seeing around things like the consolidated tape.
And where there is a gap in information between the regulatory demands and, say, people haven't yet got a solution to filling that gap, what's the impact of having inadequate data?
The biggest one is your ability to take advantage of the new trading protocols that are emerging, particularly all-to-all trading like open trading offered by MarketAxess. And that's particularly important in times like the market crisis we saw recently at the end of March, where we saw a massive increase in the amount of open trading activity as a genuine source of alternative liquidity, as some traditional liquidity providers struggled to work out where the market was at any given point in time. How we're able to do that is by using a more dynamic model for figuring out what bonds it's safe to print trades in real time in. So in Access All, we do that intraday, and we look at the level of activity in a bond, and we say that bond's sufficiently liquid at this point to be able to share market information with investors and dealers. That enables us to print trades daily in around about 3,000 bonds. Right? Now, under the more static MiFID II calculations, generally speaking, around 600 bonds will be deemed liquid on a quarterly basis and able to do that, right? And it's really that gap in the length of time of the models that really makes the difference. And that's why we find our clients get a lot of value out of Access All, because it can give you a lot more information and probably better reflects the sort of episodic nature of liquidity in bond markets.
And so it's fair to say that there is data out there which is potentially available. The challenge is that investors need to know where to get it, how to get it, and you believe that the utility model is unlikely to actually resolve that issue for them?
One, it's commercially unlikely that a utility would emerge. I think that may have to be mandated in some way, shape or form. Certainly under the current regime, commercially, it's not a viable prospect. But I think that the bigger issue, which I think is not getting enough press relative to the distribution mechanism, there's a little bit like putting the cart before the horse, right, is the fact that the regime itself is still very new. It's very, very tightly calibrated, perhaps sensibly as a way of starting off the regime. And the data quality issues that firms are experiencing with it is undermining the usefulness of that data. So there's a lot of work to do, in my mind, before we talk about this utility, to get the regime to a place where it's sufficiently bedded in and correctly calibrated. And my suspicion is distribution at that point would take care of itself, because the real issue, Dan, is lack of demand.
And so what would be your ideal model going forward to create progress for the industry?
The first issue that I think is well known that we need to address is the quality of information going into the transparency regime. I suspect it's slightly easier for venues because the trades are agreed electronically. So I suspect the focus is going to need to be more on OTC information over the coming months, and how we make sure that that information is reliable and that firms are confident to trade on the back of it and use it in their price formation process. That's probably number one. I think we need to look carefully at the calibration of this regime. As I've mentioned before, it's been carefully calibrated. The existing legislation actually includes a process to increase the amount of transparency as we go through in 4 stages. And I think carefully monitoring whether we can move through those ratchets over the coming years, I think would be the way forward. And I think the third thing that we should be looking to do is to bring a little simplicity to the MiFID II regime. It's very, very, very complicated, particularly when you compare it to, say, Trace. In the US operates on a much more simple basis. So maybe there's something we can learn from that in terms of bringing a little more simplicity to our regime here.
Jason, thanks very much. It's been brilliant.
Oh, thank you very much, Dan.
I'd like to thank Jason for his expertise and, of course, you for watching. To catch up on our other shows, go to tradertv.net or etftb.net.